Welcome back to Opportunity Cost Investing, everyone. This video is going to be on how to measure the performance of the S&P 500 and how to benchmark it against your performances. The reason why we want to use the S&P 500 is because time and time again, the S&P 500 is shown to outperform most individual and even institutional investors. We use benchmarkings in opportunity cost investing because you always want to know how your performance does in relation to other performances. For example, if I told you I invested in a stock and made 20%, well, that actually doesn't tell you anything, because what if my alternative could have made me 30%, or something that was accessible to everybody could have made 30%. I was aware of, and I could have invested. I knew it, but I didn't. That's very important. So before we dive into how to do it and how to calculate it, I want to make a few notes. First, we're going to be using the S&P 500 total return. There's actually multiple different types of total returns, some that take into account like taxes or other considerations. For the sake of argument, I'm just going to use the total return, and that's the one I personally use. Depending on your analysis, you might want to use a different one, but for this video, we're just going to keep it simple. Now, there is a difference between the S&P 500 and the investment vehicles that you invest in. For example, if I were to say my opportunity cost is actually Vanguard's VOO ETF or VFIX for the mutual fund, the mutual fund or ETF isn't going to be an exact copy of the S&P 500. I mean, first of all, they have an expense ratio, and that might be because they have overhead or they need the licensing to use the name S&P 500. So although it's not going to be precisely accurate, it's going to get relatively close. And brutal honesty, I don't know how to get the historical data of a security like VOO or VFIX. So if anybody knows, I'd greatly appreciate it. But for now, I feel as though, and I've done enough math to know, that the S&P 500 total return is going to get you really close. And with that said, we're going to dive right into the video. To benchmark against the S&P 500, we're going to have to find the historical data for the S&P 500. However, instead of using the S&P 500, we're going to use the S&P 500 total return. To find that, you can go to Yahoo Finance and type in SP500TR, or you can just type SPTR into Google. From here, you're going to want to hit historical data, and then you can pre-select your range for the dates that you want to do your analysis on. For this example, I just clicked year to date. After you choose it, you hit apply, and it'll change the information for you. From there, you hit download, and a CSV file will be downloaded, which we'll dive right into. Once the CSV file is open in Excel, I like to clean up the data. I don't need any of these columns or the volume column. The only ones we need are the date and the adjusted close. Notice that when Yahoo Finance exports data, and I'm speaking from a place of pain here, they don't include the weekends or the holidays or any time the market's closed. I've done full analyses. I don't know. I've done a full analysis where I forgot to fill in that information, and I've been burned and had to redo the entire thing. So, learn from my pain. So, for example, third is Friday, 4th and 5th are missing, Saturday, Sunday. The 11th and 12th, Saturday, Sunday. Anyway, now you have your total return for the S&P 500. How do you calculate a performance? Because you need to calculate a performance if you're going to benchmark it, right? What you're going to want to do is say, we'll make up an example here. We're going to do the 13th of the month and the 2nd of the month and the rate of return in between. You're going to want to take the ending balance minus the beginning balance divided by beginning balance. I'm going to convert that to a 2-digit percentage, and in that period, the S&P 500 returned 0.98%. Because it's a percentage in a period, it's called a periodic rate. Self-explanatory, right? Nice and easy. I like when that happens. So if you had a performance of a stock, say Berkshire Hathaway, that performed in the same period. So say you bought it $200, and this is just made up numbers, made it simple. I just chose Berkshire because I have a crush on Warren Buffett. Say you bought Berkshire Hathaway for $200 on the 2nd, and on the 13th, it's worth $204. Again, just making up numbers. you would use the same percentage calculation, and you would see that it grew 2%. So if you didn't make any contributions or withdrawals, you didn't buy or sell, you didn't have to pay any taxes, you didn't have to pay any fees, and this is all the information you needed, then you can say, I invested $200 in Berkshire Hathaway on the 2nd, and on the 13th, I had a current 2% periodic rate of return. Now the difficulty coming with communicating your performances comes when you buy and sell, withdraw and contribute. I'm sorry, guys. I'm so sorry. I'm learning as it goes. I'm actually going to keep that in there. I don't know why. Maybe to make it laugh. I feel like I'm pretty serious, so I'll just leave that in there as a spice of flavor. Otherwise, it'd be so strictly on the numbers, it'd just be so boring. I even forget what I was saying now. Anyway, it makes a difference if you buy and sell, withdraw, or contribute. Whew. If you had to pay taxes, fees, or anything of that sort. What you would have to do instead is find a money-weighted rate of return, which I'll do in another video, which I'm super excited about because I'm a huge nerd. Also, to communicate them, you're going to want to find your effective and annualized percentages. But for now, and for this video, this is what we're looking for. That's all you need. Are there other ways to measure against the S&P 500 with dividends? Of course. However, I don't necessarily like them. There are subscription services or software that you can get that will help you measure against the S&P 500. Even so, sometimes your portfolio will dictate that you'll have to do separate analysis aside from that. So it might not even do everything for you. And for the average investor, the cost of those services are actually so large that usually the costs outweigh the benefit, or it's just not a reasonable amount to pay for that kind of thing, especially when the method I just showed you is free. Additionally, some investing platforms, like I know Webull does it, has a simulated holdings feature, where anytime you invest in a security, you can invest a simulated holdings in the same amount for the S&P 500. Now that to me sounds more arduous than letting it go by and then doing the analysis prior. But that's up to your interpretation and how you feel about it. Everyone's different, of course. So I hope that helps you if you're trying to measure your performances against the S&P 500, including dividends. Obviously, if you didn't want to include dividends, you can just use the S&P 500. But now you have that tool at your disposal as well. Thanks everyone for watching. I hope you share and subscribe. Hit that notification bell so you can get more updates on opportunity cost investing so we can help raise your individual rate of return and make you more money so you can do greater things with it.